Hello, everyone. Welcome to Accounting Focus. My name is Kolaji, a young chartered accountant, and today's episode is going to focus on solving past standard question on IAS 40 investment property. So, our previous episode laid down the principles of IAS 40. So, as usual, we are coming to solve a number of questions to make the principles more practical. All right. And today's episode is going to focus on initial measurements under IAS 40. So without wasting much time, let's see what this episode has for us. Now, One Touch Limited is one of the few companies to benefit from the sale of 50 housing units in January 2008 at the Lawales Estate after the Ghana at 50 celebrations in 2007. It acquired 12 bungalows at a cost of 350,000 each. So 12 bungalows at a cost of 350,000 each, under a special government of Ghana disposal scheme for subletting to its executive employees. Additional information. One Touch Limited incurred 45,000 in legal fees and another 30,000 in professional fees, professional valuation fees in acquiring the property. That is fine. In anticipation of a horticultural landscape improvement of the properties, the company deposited a truckload of black soil at each of the properties valued at 12,000 per load. All right. These have now been washed away by torrential rains due to undue delay in starting the project. We will come back to this. It's very important. One Touch Limited has realized that it incurred certain incidental or miscellaneous expenses. However, the exact amount could not be established. It was certainly not below 11,500, but could not be as much as 19,500. So they are saying that this amount cannot be less than 11,500. It can also not be more than 19,500. The IRS has charged 2% of the value of the properties as property stamp duty. So, of course, if you purchase an asset, if you purchase a building, you pay stamp duty. In accordance with IAS 40, the requirement, explain how much each of the items I to IV above should be treated in the books of One Touch Limited. Compute the cost of investment property to be treated in the books of One Touch Limited. And then C, state the two principles under which an investment property is recognized as an asset. This is like a very simple question. Even if you don't find it simple, trust me, by the end of this explanation and then solving, you appreciate the concept. Okay. Now, A says that we should explain how much each of the items I and IV above should be treated in the books of One Touch Limited. So books of One Touch, let's not forget, the name of the company is very important. Books of One Touch. All right. So focusing on the A, I'm not going to write it, but I'll explain it. The A, One Touch Limited incurred 45,000 in legal fees and another 30,000 in professional fees, valuation fees. So this will be added to the cost of the assets. Why? It was a directly attributable cost. They told you specifically that in acquiring the property, if these properties has not been incurred, these 12 properties has not been acquired, we wouldn't have incurred this cost. Is that not it? Now we are also saying that there was a truckload of black soil that was sent to each of the properties, and it was 12,500 per load. And you mentioned that these have now been washed away by torrential rains due to undue delay in starting the project. So this is a startup cost that we mentioned that it should not be part of the cost of an asset at initial measurement. So we mentioned that at initial measurement, when you take the cost, we are saying that you should focus on purchase price and then directly attributable cost. And then some of these excluded costs includes startup costs, operating losses, and abnormal waste. And these operating losses, you are saying that if you incur any form of operating loss before the asset is ready for its intended use, then we cannot add that particular amount as cost of an asset. Is that not it? This startup cost you are talking about, we are saying that until it was necessary for you to incur that asset in bringing the asset to its present state in which management are satisfied with, then you cannot add it as part of the cost of an asset. Abnormal loss, we also established the basis in our previous video, okay? So this startup cost will not be included. It will not be included. Why? It will not be included because if not for the fact that they delayed, they delayed in starting up the project, they wouldn't have been washing away of what that particular sale. So that cost they incurred for, that cost they incurred for paying the truck drivers for loading, that black soil on each of these properties cannot be part of them the cost of the assets. It will be expensed, because it's not directly attributed. It is the undue delay which caused the washing away of what that particular soil. Now, we are also saying that One Touch Limited has realized that it incurred certain incidental or miscellaneous expenses. However, the exact amount could not be established. So this incidental, what you have to know is that if not for the fact that they acquired this building, they wouldn't have incurred. We don't know the makeup of this, but it has to do with a whole lot of different expenses coming together. So they are incidental. So what it means is that if not for the fact that they acquired the building, they wouldn't have incurred these expenses, But then they don't have a particular amount. It's an estimate. So what we will have to do is that we have to go with the higher one. So that will be on the safer side. Is that not it? Because you are saying that it's not less than 11,500 and it's obviously not more than 19,500. So we have to make a provision of 19,500 and this must be added to the cost of the asset. Then we are saying that the IRS has charged 2% of the value of the properties as property stamp duty. So we have to calculate 2% of the value of that particular building that we acquired and we charge it as what? Stamp duty. Are you getting the picture? So that is for A. Now when you talk about B, with IV it will be added as part of the cost of the asset. Are you getting the picture? Because it's a direct attributable cost. So when you talk about B is saying that we should look at the cost of the asset. So when you take the cost of the asset, what is the currency? The currency is Ghana cedis. All right. So first of all, we have to look at the purchase cost. So the purchase cost. So how many were they? There were 12, right? At a cost of 350,000 each. They mentioned it. So that information is here in case you are lost. 12 times 350,000 each. So make sure you get your calculators because I also have my calculator with me. So make sure you get your calculators. All right. Then we have B. So there is legal fees. We have to add the legal fees of how much? 45,000. So let's calculate the 12 by the 350,000. So 12 times 350,000. That is 4.2 million. So 4.2 million. All right. Then there was professional fees. So there was professional fees. How much was it? This professional fees is 30,000. So you're going to add 30,000 to it. All right. Now, we know we are not including this. Why? Because it's not a direct attributable cost. It's a startup cost. We are not going to include that. Then we are also going to make a provision for the miscellaneous expenses. Provision for miscellaneous expenses. And how much did we agree on? 19,500. So they gave us a range and we are obviously going with a higher amount. Then stamp duty. That will be 2% times the 4.2 million. And you know why, right? Because they said 2% of the value of the properties, right? So what is the value of the property? The value of the property is the 4.2 million. So we calculate 2% times 4.2 million and we are having 84,000. So this is what will be added as what cost of the assets in the books at initial measurement, right? So that will be 4,200. So 4.2 million plus 45,000 plus 30,000 plus 19,500 plus 84,000. So this is going to give us 4 million 378,500. So this will be the cost of the asset. This is what you are going to show in our balance sheet at initial recognition. Okay, so that is it. Then when you talk about C says that states the two principles under which an investment property is recognized as an asset. So we've already explained this basis, in our previous video, but because it's question solving, I'll still put it down. So we are saying that one, in terms of recognition, at what point can we recognize investment property as an asset? There must be two conditions. One, future economic benefits associated with this investment property must flow to the entity. So what it means is that if you acquire this investment property, okay, you should be able to use it to generate, cash flows, cash inflows. Is that not it? So you're using it to earn rentals. That rental income, is it coming to you as the business? Yes, it's coming to you. So it means that benefits are flowing to you. And we are saying that don't forget that it must be highly probable, more than 50% chance. So probable that future economic benefits should flow to the entity. And then B, we are saying that the cost of the asset should be reliably measured. Can you give value to your assets? That's what it means. I get in the picture. So if you can reliably measure the assets, and then there is the high probability that future economic benefits will flow to you, the entity, for owning that asset, then it means that we can go ahead and then show this investment property as an asset in our statement of financial position. Okay, so this is a very simple question. This is a past standard question from Institute of Chartered Accountants, Ghana. So if you appreciate this, kindly hit on the like button. If this is your first time joining us, tap on the subscribe button to subscribe. Share to your friends so that they can also benefit from this free lecture. Okay, now I'm going to release subsequent videos. Our next episode is going to focus on the subsequent measurements, which talks about fair value model and then cost model. And then the point where we can also transfer an asset from IAS 40 to IAS 16. And then we can also transfer an asset from IAS 16, that is PPE, to investment property IAS 40. Okay, so these complexities can come in sometimes. So it is better if you get a practical question solving to make the understanding more practical. So until then, we call it a day. See you all.